It's a pleasure to welcome Matthew Peterson, Managing Partner of Peterson Capital Management. Thank you for being here with us.
Thank you, Shai. I mean, it's not often that I get to come to Switzerland, so it's a real pleasure to be here and see you again.
So we're here to talk about Dhandho Holdings. What about Dhandho Holdings grabbed your attention?
It's a very good question. So Mohnish originally wrote about Dhandho Holdings in 2014, and I believe his 2013 annual letter. I think one of the most important aspects of Dhandho itself is the alignment of interest and the fact that you could look at permanent capital vehicles around the globe and you're not going to find one that is based on such long-term thinking, right? 5-year rolling payment cycles based on book values outperformance of an S&P 500, including dividends. And I think incentives are very powerful, and I think that that is the right incentive, and it really aligns the interest of management with the investor's interest.
So give us some background of what Dhandho Holdings is, please.
Right, so Dhandho Holdings is a permanent capital vehicle run by CEO Mohnish Pabrai. And Mohnish has had great success in starting ventures in the past and also in running a fund. I mean, he is a super investor with great success over multiple decades. He is, in 2014, launched Dhandho Holdings to operate as his permanent capital vehicle.
And from the outside looking in, how do you gain comfort that you know what's going on?
Well, that's a good question. There's actually quite a bit of legal documentation surrounding Dhandho. Of course, it's locked up in the Dhandho Holdings website, but there's a long history of Mohnish's performance, and the legal structure is actually, I think, designed very, very well, and gives you a great comfort.
And I understand you do have a material investment in Dhandho.
Mm-hmm.
What was your process to understand the nuances and to gain comfort that it's a good long-term portfolio holding?
Mm-hmm. That's a great question. So I think I think fund managers in general benefit greatly when capital becomes permanent. And you look around at the super investors of the world, many of them launch, when they are able, they launch permanent capital vehicles. They no longer have to deal with cash flow issues or redemption issues, and it allows them to make strategic long-term decisions. So when Mohnish started talking about his process and him moving in that direction, it was very interesting to us, and we were able to basically I got access to all of his legal documentation, went through it in great detail, had our legal team review the Dhandho material, and that is what basically were the steps to our participation.
And when you think in terms of time horizons, are you measuring Dhandho in 3 to 5 year horizon, in generational horizon? How do you grasp liquidity? How do you grasp a full cycle?
I think that is a very good question. Let me take a step back. So Mohnish has several levers that he can pull with Dhandho, and they are each very powerful. So in the past, with an equity portfolio, he has one lever. But with Dhandho, he can buy wholly owned private subsidiaries, he can start internal businesses, and he can use the equity markets. These are all in nature much longer term time horizon. I think naturally I have a long-term vision. We're long-term value investors. I will watch ROIC, return on equity, and the capital allocation very carefully. However, I am not concerned at all about a quarter or 12 months. Definitely looking out decades.
And Greenlight Re is fairly well known, and other similar larger managers have their similar reinsurance vehicles. Mm-hmm. At what point do similarities become appropriate? At what point do similarities not really apply to Dhandho?
That's an interesting question, because Dhandho, I think, has a little bit of a broader approach to where they will allocate their capital. Dhandho definitely is in the insurance space. However, Stone Trust, their initial purchase, is actually 40% of their portfolio. They're not looking to be, I don't think, a major reinsurer. They're not putting themselves in the box of ultimately running a major insurance entity. So there are definitely parallels because of the permanent capital vehicle that we discussed. But I think that Mohnish is much more willing to build up a team, an international team of very bright, driven individuals, and start a business internally that has potential to actually dwarf the entire insurance business that they've already purchased.
So one major benefit of reinsurance vehicle is the float. Mm-hmm. And there currently seems to be an insurance operation in the vehicle at this point. Mm-hmm. Could you help us understand the nature of the float? Is it long-term, short-term premium? Is there a sense of economics for this float?
Sure. So the float with Stone Trust is actually interesting because most of it's actually regulatory capital. And so, Mohnish through the subsidiaries will have access to debt markets. So he will be able to bring on debt, but also use float. Because it's regulatory float and interest rates are so low, you don't have a huge benefit from things that are invested in treasury bills today. But as the environment changes, and like I said, we're looking at this in 10-year, 20-year cycles, the environment can be quite dynamic, and there will be opportunities to make great amounts of money with that float. I believe now Stone Trust has around $160 million in float and maybe 45 in an equity portfolio. And a lot of that is surplus that was actually put in the company by Mohnish and by Dhandho.
So I'd be curious, what were the key questions you asked when you were trying to understand Dhandho?
So quite a few questions, actually. So I think that it's very important to understand the incentives around any business. I think it's very powerful to have an owner-operator who's an excellent capital allocator. And if you have any business that's in a good business environment but run by a poor capital allocator, free cash flow can be put into different opportunities that will actually erode the business. And so some key components were, is Mohnish an excellent capital allocator? And of course he is. And what sort of opportunities will exist? What sort of mindset does this capital allocator have? One thing that I really like about Dhandho is that Mohnish looks at capital allocation as an opportunity cost. So when he's considering which levers to pull, and they're in very different spaces, he actually understands that he has a finite amount of capital and he needs to concentrate his capital in the very best opportunities. And so looking at management was very important. Looking at what opportunities are available is very important. Looking at the incentive structure is very important. The way he designed Dhandho as basically a clone of some of the original Warren Buffett partnerships with some very strong alignment of interest components is very powerful. So these are all things that were very important and things I was looking at.
And how do you think through the range of outcomes? And how do you think through the risk factors that are worth keeping on your radar?
Great question. I think that in the value space, a lot of folks focus on either the positives or the negatives. And the fact is that there is a range of possibilities, right? Nothing is guaranteed. So one thing I liked initially when we were putting our money into Dhandho, we were basically buying cash for cash with Mohnish as the capital allocator and CEO. He started building this team, which basically I believe has intrinsic value of itself greater than book value. And yet we're buying it at book and we hold it at book. So what are the range of potential outcomes? Well, he's allocating small pieces of money, $1 million here, $2 million there, to venture opportunities that could be 100 baggers. But many of them might not work. I mean, this isn't a business about ETF or about small business direct. This is a business about small opportunities with asymmetric payouts. So there will be, so first of all, there's a lot of cash on the balance sheet today, and that's very valuable. Stone Trust has been operating at about at a combined ratio a little over 1, and they're looking to get that to 97. So what I expect to, the range, I think the downside is pretty well protected. They have a number of, they have an equity portfolio, fully owned subsidiaries, a lot of cash on the balance sheet, and they're making small venture investments and little startups. So by the time they've spent $1 million or $2 million on a given investment, they know whether it's going to be something that's worth pursuing further. So over the long term, can book value decline? Certainly it could. But I think, over the short term, can book value decline? Certainly it can. But I think once the engine really gets rolling, there's actually potential for very significant growth over many years and decades.
And you mentioned ETF as one of these venture style experimentations. Can you add more color of what's going on with ETFs?
Sure. It's actually, there's not a lot of public information on it, so you may have to stay tuned. But I do know, I think it is public that there were a number of engineers that were taken from UCLA to work as interns over this last summer, and basically build out this smart beta ETF. And the testing, it appears, is delivering a sort of ETF that is performing very well, better than the S&P 500. And actually, it doesn't really make sense to pursue it unless you can deliver something along those lines. So it's a place for some internal cash from Dhandho. Maybe some float could go into a vehicle like that. And it could potentially, if it performs well, attract a significant amount of capital from outside Dhandho. But again, Dhandho isn't about the ETF. It's about the mentality, the capital allocation mentality that Mohnish Pabrai has, where he's willing to take these long-term views. He has a permanent capital vehicle. He can start this, and the potential is it's a very asymmetric payout if something like this works.
So one element of a reinsurance vehicle is the float. Another element could be the structural benefit of having tax benefits and other type of structural edge. Could you share your thoughts on Puerto Rico and how that fits in?
Absolutely. I think the 20 Act is something that has been overlooked by a lot of folks. It's actually quite new, so it's really exciting that Mohnish is sort of a pioneer moving this space. For those who don't know, Dhandho headquarters relocated to Puerto Rico to take advantage of this. So I believe Dhandho, as a holding company, will receive a 4% corporate tax for the next 20 years, which is quite significant. So there's two aspects to the reinsurance, and for real detail, you go to Fahad, right? He's an excellent CFO, but you basically, there's the surplus and there's the regulatory capital. And I believe the surplus, as it's invested, will probably fit within the Dhandho, maybe tax at the Dhandho corporate rate. But actually, because Stone Trust is a Louisiana-based company, that's going to be taxed, as a regular entity within the U.S. The direct insurance business, Dhandho is starting an internal insurance business. It appears that would make sense to have. It is at the holding company level, and so that would probably receive the 20 Act insurance benefits offered to Puerto Rico entities.
And Puerto Rico is very much in the headlines for having regional financial difficulties. How do you define what is noise, and how do you define what is ultimately relevant in the long term?
So I think that the trouble that Puerto Rico is having in the debt space is actually a different issue from Dhandho moving there, for example. Certainly there may be a default, there may be some major changes that take place in Puerto Rico, but Dhandho itself as an entity within Puerto Rico will have no direct repercussions from the Puerto Rican authorities sort of having trouble with their issuance.
So I guess Act 20 is independent from the default narratives. Is that a reasonable worldview?
That is a reasonable worldview. I'm not an expert on Act 20, but I do not believe that Act 20 would be removed from the corporations who have been granted Act 20. If that happened, it would be kind of a black swan event. But frankly, Dhandho would be taxed like other corporations, so it's not the end of the world. It's actually a huge benefit that they have a corporation taxed at 4% for 20 years.
Yeah, so you mentioned there's a 5-year incentive structure.
Yes.
And that's quite rare. Have there been other vehicles we've seen that have similar structuring, or this is really a one-off, difficult to replicate?
You know, it really is very unique, especially given the size. It's interesting because Warren Buffett offers something similar in incentives to Todd and Ted, his two financial managers. And I believe that Mohnish probably saw that and thought it was a very powerful tool. Incentives are so important and powerful, you can even use them to monitor your own behavior. And if Mohnish is paying himself based on not some IPO stock price performance, but actually fundamental book value growth that outperforms the S&P 500, when he goes into the office every day, he will actually be focused on growing book value at faster than the S&P 500 over the long term. And if he paid himself a management fee, he might just, and no incentive structure, he might be lazy. And that's just how powerful, incentives are so powerful. In fact, Charlie Munger has a few quotes out there where he talks about how every year he finds some new reason to recognize that incentives are more powerful than he thought the previous year. So I see it in Berkshire, I see it in Dhandho, and Dhandho's is in fact, as I understand it, it's even longer because it's a 5-year rolling period. And I believe that it will really motivate Mohnish to focus in the right direction, and he knows that. He designed the incentive so that he would operate the way that he wants to behave.
And you've mentioned that there's a team that's being built, which is quite valuable as an asset itself. Could you add more color on this team and what the infrastructure looks like?
Yeah, I can add a bit of color. So obviously, Mohnish is CEO, and he's still based in California. However, the main headquarters are now in San Juan, Puerto Rico. That team is being built out. There's Fahad, a CFO, and then a few other now staff members, and that's continuing to grow. You can actually visit the website and look through the bios on everybody. Additionally, I think Mohnish actually has a competitive advantage in India because of who he is and what he's doing and his background, and he's now building out a support team in India that's helping with administrative activities and even R&D activities. And so what's very interesting is if you look at just the balance sheet, if you look at the fundamentals of Dhandho, which is where you would derive book value from, and how we hold it right currently as book value, this entity in India has a book value of essentially zero. But there is so much intrinsic value in this strong team that he's producing in India that's supporting the rest of the operations. So Dhandho Holdings is the headquarters. Stone Trust is one of the wholly owned subsidiaries. There are a couple of internal businesses, some venture businesses, cash, equity holdings, headquartered in Puerto Rico, support staff in India, and all of that's been done in a very, very short amount of time.
So there's a very clear incentive angle to Dhandho, and there's also an element that Mohnish is particularly adept at what he does. Can you give more clarity of how permanent capital could be a meaningful edge given the strategy Mohnish has?
Absolutely. Mohnish and I think very much alike, and I believe that having a concentrated portfolio allows you to outperform the markets over the long run. You have to focus on your best ideas. You can use the Kelly criterion or any other method to evaluate that. I believe that Mohnish shares the same framework. The challenge is when you have a concentrated portfolio, you have a lot of volatility within your portfolio. And for partners, limited partners, invested in a portfolio, it can make them feel uncomfortable. Once you have a permanent capital vehicle, that operational activity goes away. It actually frees up your time and allows you to make much more strategic, long-term decisions, regardless of the price volatility that might exist in the interim. So, as I mentioned before, Mohnish has 3 levers he can pull. He can go in the private markets and buy an entire business. He can put his money into equity portfolios, and he can also start internal ventures. Now it's a diversified operation in itself, but each one individually can be extremely volatile. And so he's able to very strategically allocate capital into opportunities that he might not be able to participate in less of a permanent capital vehicle.
When we talk about 3 separate feet to the stool, could you talk about the other 2? How Mohnish has capability as an operator of a business, and he also has experience starting up companies?
Absolutely. I think that's a key component of all of this as well. The fact that Mohnish has been successful in the past with his startup ventures, very successful in the past with his startup ventures, and then very successful with a public portfolio opportunity. He's now just combining his previous successes into a permanent capital vehicle, which we know offers its own competitive advantages. So I believe that because of the nature of the business and the successful track record that Mohnish has had, and his ability to allocate capital strategically, thinking of money as thinking of capital allocation in terms of opportunity cost, all of these add small amounts of alpha that when you sum up all the parts can actually be an incredible competitive advantage over a long period of time.
So I think Mr. Pabrai is well known as a fund manager. Could you share further detail on his business experiences before running a fund?
Sure. It's been a while since I've thought much about them. What I can share is that he had a technology business, and I think actually a lot of this he writes about it in the Dhandho Investor, which is the book that he published a few years ago. So he had a technology business, and I believe this is actually one of the characteristics of Mohnish that is also very valuable. He has an entrepreneurial spirit that will allow him to overcome challenges and be successful through his creativity. He was focused on one aspect of in his technology space. He was focused on one particular problem, and he recognized very high margins in a different space. And I think it was sort of a PeopleSoft kind of space. And very quickly, he redirected the business and said, let's just work on the problem that has very high margins. And within a number of years, it was a very successful business. He saw an opportunity. He took advantage of that opportunity, and of course, then was able to sell the business for a very nice profit.
And you've talked about the India-based back office and research platform. Mm-hmm. Is this possible to visit, or is this really based on document research?
Yes, you can visit. I think it's in Prune or Dune. I can't remember I have not been there, but you can visit. Originally, the staff was 2-person staff, right? So again, it's a very small operation. I believe they're building it over time, but there is an office. There is a bit of infrastructure there in India.
And as people try to think through a checklist of Dhandho, what would be some of the more interesting checklist items that might not be the most obvious to think about?
Well, I think certainly watching the allocation of capital very carefully and the components that it's going into is going to ultimately determine the long-term success of Dhandho. So making sure that I believe that Mohnish Pabrai will make very wise capital allocation decisions over a very long period of time. But I think it's something to really keep watching and monitoring over time. The other interesting aspects, I think, I think it will be interesting to see how over the long term he uses debt within Dhandho and he uses float aspects of Dhandho. And that will also be a big engine behind some of the future profitability.
And are there any mandates within Dhandho to be within a certain type of insurance or a certain type of business acquisition, or is it purposefully open-ended?
So Mohnish has some criteria that he actually has listed on the website and in the legal documentation, but it is very broad, and it's broad by design. But it's actually it directs him to friendly business takeovers. It's a lot of qualitative aspects. Certainly directs him to more of a Warren Buffett type acquisition criteria than a traditional PE kind of acquisition criteria.
And there's oftentimes a worry that sellers know why they're selling and buyers find out later. And also the issue that sellers have a price that they determine and the buyer needs to say yes or say no. Are there any ways Dhandho tries to mitigate these patterns?
Absolutely. But I think it's done very subtly, and when you read between the lines, you actually can see it. I think it's commonly understood that the PE market right now, there's a lot of money there and a lot of interest there, and the prices are very high. And as Mohnish went around looking for insurance entities in particular to acquire, I think he recognized that the price was really high. And so instead of simply acquiring these highly priced insurance entities, he took a much lower level of capital and started one internally, which is very, very interesting. Because he has the 3 levers he's able to pull, he can actually publicize in his letters to partners and to investors that we're really focused on our internal businesses. We're actually not that interested in acquiring businesses. But if you have something that is so incredibly interesting, we might consider looking at it. And because of that, perhaps he'll see a filter of a few of the best ideas. But he's not committed to buying businesses. He has other levers he can pull. And so it really will be interesting if he can build a brand, if Pabrai can build a brand around Dhandho, like Berkshire, where sellers actually want to sell to Dhandho. And I believe that ultimately that is one of his goals.
Is there any public narrative how the first deal transpired? How this Louisiana company found the Puerto Rican entity? There are press releases and there are letters that are available on the Dhandho Holdings website, but there are not,
it's not hugely public. There's not interviews going on between the entities. I think similar to the Buffett mentality, Mohnish would like to do deals with a handshake with honest people. He wants to do friendly acquisitions, people that want to be part over the long term of Dhandho Holdings, and so. Mohnish was looking very carefully, he's very detail-oriented, was looking very carefully around the nation for insurance opportunities, and Stone Trust happened to be a very good match for Dhandho.
And if it's there might not be an answer, but why would Dhandho bring something to the table and Stone Trust likely respects what Dhandho brings? Mm-hmm. Why would Stone Trust be willing to sell if they have a terrifically well-managed, high-quality operation?
That's a good question. Typically in the insurance industry, everyone is very, very good at the management of the insurance business. It's actually becomes very powerful when you have an exceptional capital allocator also on board with the insurance entity. Stone Trust now has the ability to expand further. Because of Dhandho's backing, they have the ability to increase their AM Best rating and offer extensive policies. And furthermore, they actually don't have to worry about the capital allocation piece. They can focus on what they're best at, and they can hand their capital to Dhandho, and Mohnish can do the capital allocation component. So it's a bifurcation of some of the responsibilities, which will actually make both entities more powerful.
Are there nuances in how Stone Trust is incentivized?
There are. The actual so Stone Trust is incentivized in the right manner. They are not incentivized by growing revenue or selling policies. They're actually incentivized on how well they can on keeping their combined ratio below 1, and how well they can actually grow their underlying profitability. And that is really what is important. During times of low pricing, it does not make sense to compensate an insurance management team on growing revenue, because they overextend themselves and take risky policies. So the incentives are actually done in a proper way with Stone Trust, focused on growing actual cash flow and keeping the combined ratio below 1.
So the incentives Mohnish has seem to be well enunciated in the documents. Mm-hmm. Are there similar documents that cover Stone Trust's time horizon and their bonus formula or anything else that's analogous?
They're really, it's actually a wholly owned subsidiary, so it's difficult to find details around Stone Trust. It's more some of the interviews that you've seen even on the MOI site, where Mohnish talks about some of the incentive structures that he's laying out.
And it sounds similar to Arch Capital or to Markel or to Fairfax. Is it reasonable to assume that the documents would likely look similar, or is there any type of framework that could be comparative or could be referenced?
Yeah, I think ultimately Dhandho could grow into a firm of similar nature, right? Carving out its own sort of niche areas in the process, but I believe that Fairfax, Markel are great examples of what Dhandho can become.
And I think Markel, I believe, is trying to focus on certain types of insurance as a niche. Mm-hmm. Is there a similar philosophy at Dhandho to stay within a certain type of insurance policy, or is it truly open-ended?
So I believe that Mohnish will focus very hard on staying within his circle of competence. But that circle of competence is not defined. And I also believe he's pushing very hard to grow the circle of competence. So there is no defined space where he will or will not be 25 years from now or 10 years from now. But I do believe that he will focus on key areas where you can have a combined ratio below 1, where there's growth opportunities, where there's maybe a niche space with high margins, kind of the standard focus areas of a well-trained value investor.
And how would someone gain further appreciation for what makes Stone Trust unique? Are there any ways to understand the business lines or to understand their granular economics, to really dig deep into Stone Trust?
You can look through the regulatory filings to see some aspects of Stone Trust. But Stone Trust in itself can become a unique business simply by, you don't need to do extraordinary things to have extraordinary results. I think Stone Trust is a wonderful business that fits very well with Dhandho, but most importantly, keeping the combined ratio below 1, having a slow growth plan, keeping that AM Best rating up are all very, very valuable components of the Stone Trust business.
And is there, I think Markel tries to find smaller market-sized insurance niches, which are oftentimes underserved.
Mm-hmm.
Is Stone Trust doing a similar niche product line, or is it just very well cultured, and why are they able to stay below 1 consistently?
It is. I mean, they operate in 5 states. They're based in Louisiana. They basically are doing workers' compensation type insurance. So it is a little bit of a niche space. I think there's enough that it's sort of a commoditized product, but they can of course expand into other areas, and then there's a now internal business, the Dhandho Insurance direct business that Mohnish is starting, and I do believe that that operating in a niche space is absolutely going to add value for Dhandho as a whole.
And I've understood insurance to be high frequency, low severity, or high severity, low frequency.
Mm-hmm.
How do you think through workers' comp in that framework?
So
it's not supercat, presumably, so it's more like automotive.
Absolutely. It's high volume, low severity situation, right? I mean, the workers' comp insurance products really have relatively low margins compared to some of the other sort of Markel pieces. But I think this is just one building block to a major sort of castle under Dhandho Holdings.
And how do you recommend someone perform independent due diligence? Is it document oriented? Would it be interviewing key people? Would it be?
Absolutely. There's a number of steps you can take. It's interesting because currently it's very private, right? It's very unique. It's very private, and but the documentation, the legal documentation, is available through the Dhandho Holdings website. So if you're able to get access to the website, you're able to get access to all of the legal documentation. Mohnish is also very transparent, especially transparent, and writes, I think, very thorough quarterly reports on the activities taking place at Dhandho. There's also the financial statements, both audited and unaudited, that are placed quarterly on the website. So you're able to review all of those in detail. Outside of that, of course, there's now an annual meeting that takes place in Puerto Rico. So folks are welcome to attend that. And I think interviewing key people like Fahad is of real value as well.
And I believe you've been quite familiar with Pabrai Fund's operating history. You've attended several Pabrai Fund meetings. Mm-hmm. Can you share with us your impressions of having been a long-time Pabrai expert?
Absolutely. Look, I think Pabrai is an excellent capital allocator. I mean, he's a well-known super investor among a group of maybe 100 value investors globally. I have been following Pabrai for many years. I was actually originally informed about Pabrai by another fund manager, Jeremy Deal, in 2004. And so I started following Pabrai very closely. I had the opportunity to meet with him at a book signing in Dairy Queen in Omaha. And then from there, we had a number of conversations over the years. I think that Pabrai does a very, very outstanding job of presenting himself and the fund in a very, very transparent and honest way. I think that he has implemented a number of very interesting and now more common, but then very unique policies, such as his checklists and a few newer investment ideas from maybe other disciplines. And I think, as we all do in this space, he has grown very quickly as an individual throughout the decades that he's been operating the fund. And we all are on this path of self-improvement. And I think he is very quickly moving from his fund to a permanent capital vehicle and doing very interesting things.
So you've spent more than a decade trying to understand what makes Mr. Pabrai so special and unique. Mm-hmm. What have been ways that you've improved yourself from these insights?
That's a very good question. Well, certainly I have a lot of improving to do. But I think, for one, I understand the power of incentives, and I have designed my own life to incentivize myself to act and behave in business in the way that I would like to. So incentives are so powerful that by simply charging a high management fee, you can relax, and by charging a higher performance fee, you're focused on performance. And that's a very powerful idea, and not a lot of people are willing to implement that. I think Pabrai is very focused on things both in business and outside of business, in terms of just having a very holistic life, and it's something that I think is very valuable, and I think that the combination actually helps him both as an investor and as a father, husband figure. So there are many great qualities to Mohnish, but I know he's constantly on this journey, and so are the rest of us.
And you mentioned that a trusted associate brought Mr. Pabrai to your attention. Do you try to focus on one? How do you orient being independent versus having trusted advisors who you share ideas with? Do you adopt a Mohnish approach of having a Guy Spear co-pilot? Do you try to stay isolated and avoid noise? How do you navigate being alone versus being on a team?
That is a great question. So there is so much noise in the marketplace, and it really is difficult to filter out all the noise. I have several folks that I would consider not only trusted advisors, but also fellow colleagues that run similar funds. We have a group in California, the 10K Club, that is filled with really bright individuals, fund managers operating generally independently, raising capital, running their operations, running portfolios, and we all share ideas. We all work closely and well together, and we all try to assist one another. And so I think it's very important to have that sort of support network in your life with people who are maybe experiencing similar, going through similar situations, experiencing similar things, and so having a key person or three is really valuable.
And can you share with us the criteria you look for in people who you try to keep close to yourself?
Absolutely. I think there are a lot of characteristics. Look, I like people who are very intelligent, very hardworking, people who are very honest. And I think, I could run down a huge list, but, it's very important to have people who are are full of integrity, who are full of, I think, people who are tenacious in this business, and people who are genuinely looking to sort of create a positive feedback loop within the relationship, where if I can help them, I will, and if they can help me, they will. I think that's really valuable. There are some people out there who are looking for opportunities just to get ahead. And I think in the long term that hurts them. And it's better to have a very shared sort of mutual growth in relationships.
We're very lucky to have you share with us and to have you give us some of your insights. We hope to help you in the future as well, and we thank you so much for your time and your wisdom. Thank you for being here with us.
Thank you so much, Shai.